Accruing uncollected revenue. Learning objective. Prepare adjusting entries to accrue uncollected revenue. Some revenues are earned or accrued in the current period but are not collected until a future period. These revenues are normally recorded as part of the adjusting process at the end of each period by debiting an asset account called accounts receivable and by crediting the appropriate revenue account. In future periods, as cash is collected in settlement of outstanding receivables, cash is debited and accounts receivable is credited. A revenue accrual is necessary when revenue has been earned in the current accounting period, but the cash will not be collected until the next period. Examples of revenue accruals include interest earned on investments or loans made to others and work completed but not yet billed to the customer. In the adjusting entry, we will record a receivable, an asset account, and recognize the revenue earned. In December, Overnight entered into an agreement to perform routine maintenance on several vans owned by Airport Shuttle Service. Overnight agreed to maintain these vans for a flat fee of $1,500 per month, payable on the 15th of each month. No entry was made to record the signing of this agreement because no services had yet been rendered. Overnight began rendering services on December 15th, but the first monthly payment will not be received until January 15th. Overnight needs to make an adjusting entry at December 31st to record half of the revenue earned from the agreement with Airport Shuttle during December. From the 15th of December until December 31st, Overnight earned $750 of the maintenance fee. Let's make the adjusting entry to recognize the interest earned from December 15th to December 31st. Overnight will debit the asset account, accounts receivable, for $750 and credit the repair service revenue account for the same amount. Initially, the revenue is recognized and a receivable is created. The asset, accounts receivable, will appear on Overnight's balance sheet at December 31st. The repair service revenue account will be shown on Overnight's income statement for the month ended December 31st. Overnight earned an additional $750 from the 1st of January until the 15th, when the service fee was paid. Overnight will receive a total of $1,500 on January 15th. Once again, be careful because part of the $1,500 has already been recognized as revenue. Record the entry for the receipt on January 15th. First, debit the asset account cash for the full $1,500. Next, credit the repair service revenue account for $750, the amount earned during the month of January. Finally, eliminate the accounts receivable account for $750. This must be done because the cash has now been received for service provided in December. The receivable is collected in a future period. A corporation must pay income tax on its taxable income. This liability is paid in 4 installments called estimated quarterly payments. The first 3 payments normally are made on April 15th, June 15th, and September 15th. The final installment is due on December 15th. But for purposes of our illustration and assignment materials, we will assume the final payment is not due until January 15th of the following year. It is always necessary to accrue income taxes for a corporation. The adjusting entry is just like the entry we record for any accrued expense. In 2018, Overnight earned income before income taxes of $66,570. Income taxes expense for the entire year is estimated at $26,628. $66,570 times 40%. Since Overnight has recognized income tax expense through November 30th amounting to $22,608, the December accrual will be for $4,020, or $26,628 subtract $22,608. The adjusting entry is to debit income taxes expense for the accrual and credit income taxes payable for the same amount. In this case, the taxes accrued are $4,020. Corporate income tax rates vary around the world. A recent survey shows that rates range from 9% in Montenegro to 55% in the United Arab Emirates. Worldwide, the average tax rate is 24%. The average rate in the United States was 40%, which was the highest rate among the Organization for Economic Cooperation and Development countries. In addition to corporate income taxes, some countries also withhold taxes on dividends, interest, and royalties, charge value-added taxes at specified production and distribution points, and impose border taxes such as customs and import duties. A few countries, including the Bahamas, have no corporate taxes.